Nilesh, fantastic to have you back. Thank you for joining us. Nilesh, lots of news, lots of deals, a lot of views on where inflation and interest rates are headed, but markets are in a sense, the ability of this market to shrug off bad news and the noise is quite incredible, isn't it?
Absolutely. Good morning, Nikunj, to you and all the viewers. Yeah, absolutely. I mean, really, the markets have been able to take the second round of COVID and the infections in its stride, and there is still a very strong liquidity which continues to basically flow into the markets. In addition to that, some of the very short-term high-frequency indicators have essentially still been, in a way, pretty much positive and have been having relatively strong momentum. So on the whole, what it looks like is that the market is essentially being able to take any kind of softness which may be there in the June quarter numbers and is willing to look at more the second half of this financial year and beyond. So on the whole, I'd probably say that the markets probably are more in a medium-term mindset rather than just looking at the absolute short term.
Nilesh, let's talk about market behavior. One side we are saying that markets have run up and there is a froth. But if I do a dipstick, forget 8 out of 10 or 7 out of 10. 10 out of 10 folks are saying this market is not going to sustain. There is a bit of complacency which has kicked in, sit on cash or go short. So while everybody, in a sense, wants to participate, but nobody has got strong commitment levels. Would you agree with that?
Well, the market will always have very, very divergent views, and that's what essentially makes the market, and that is what the market is all about. You are going to have very divergent views, very contradictory opinions, and all of that. But let's kind of look at this very objectively. That pre-COVID, and if I were to just kind of look at the Nifty, we were at 12,500 versus that we are at about closer to 16,000. Now, yes, that's like kind of an up move, but it's not like a terrible up move. It's not like the markets are trading at probably a 2x levels of where they were pre-COVID. And the outlook for earnings is very, very strong. Let's like really face it that it's quite possible that over the next year or two, we could end up with maybe a 20-25% CAGR in earnings, although it's on a low base effect. So while on one hand there is some bit of caution, there is some bit of skepticism, but on the whole, the market still continues to receive net liquidity. In addition to that, of course, there's a fair bit of participation from domestic investors, from retail investors. So to that extent, a combination of all of these things are basically driving the markets, and in a way, the momentum in the markets or the price levels are pretty much reflective of the earnings growth which companies have been reporting. It's not like that there are no earnings and markets still continue to high. That I believe significantly differentiates 2021 from 2017. In 2017, we just had a gush of liquidity, and the liquidity was just backing hope, saying is that yes, things will get better. The reality this time around is that it's actually the earnings first, and stock prices in a way a bit are following the earnings growth. So to that extent, I agree that yes, there is some divergence in opinion. But the common sense or the consensus trait that I see in the market currently right now is that there is a very strong backup in terms of earnings, and that to me is very, very heartening.
If one goes by the numbers which you've got from TCS, Nilesh, there is reason to believe that the quarter gone by may not be an exciting one for IT companies. And any company goes through two processes, EPS upgrade and P upgrade. Do you think for most of the IT companies, including mid-cap IT companies, the P upgrade is behind us? And if one has to bet on EPS upgrade, it may be at max early double digit or mid-teens?
I totally agree with that. Clearly, the valuations have run up and the multiples have run up quite significantly for the IT services companies. By and large, the big benefit of margins, improving margins essentially are behind them. And these margins will normalize over the next year and a half. we all know that these are B2B businesses. And so at some point of time, you will have to, in a way, shed or give off some of these margins which you're enjoying to your customers, or probably deliver to them more for the same dollar that you receive. So clearly believe that for the large cap IT services companies, the upside from a pure P multiple point of view is well, there is no case for that. In terms of earnings growth, I probably believe right now that these are companies which will sustain a secular growth rate of about high single digit in terms of their revenues. And any margin expansion or any sustenance of margins will really be a factor of the currency depreciation. So if the currency were to go back to 72, maybe the upside is capped. If the currency were to go to, say, levels of 80 to a dollar, there could still be a lot more upside for some of these plain vanilla IT services companies. However, I believe that a lot of the mid-cap IT services companies are yet interesting plays. Of course, there are a whole bunch of them which have moved up, but there are then a bunch of them which could become nice targets of consolidation. PE funds out there are looking out to buy out into some of these companies. Their experience has been very good and very encouraging for them, and that's going to be heartening for them. And maybe they would basically further continue to basically be on the path that they have been. Some of the mid-cap IT companies have been changing their business models to become SaaS companies, software as a service kind of a thing, and that's where essentially there could be some still bit of earnings momentum for those kind of companies. And then, of course, there are companies which are very specialized provider of digital services. So I clearly believe that within the overall pack of IT, look out for companies which are doing R&D, doing engineering, doing basically are shifting and transforming the business models to a software as a service kind of a model. And then, of course, there are a bunch of companies which could be providing digital services. So I think that, I believe, is a very, very interesting segment.
That there is a bit of uncertainty when it comes to the revival of the overall economic growth. Would a prudent strategy be to bet on the defenses such as pharma, FMCG, and IT?
Well, of the three, I clearly believe that pharma still represents, one of the best growth opportunities from a short, medium, and a long-term perspective. Clearly, that continues to be one of our most favorite sectors. Consumer as a space is again very interesting, but I would say that there are still, I still believe that the top-run consumer companies are fairly valued to maybe overvalued right now. But there are a bunch of smaller consumer companies which look, very, very interesting. And then again, within the IT pack, I would think that probably, look out for some of these mid-size, small-size firms which essentially have the triggers for transformation or triggers for change. So I'd say that in pharma, both large cap and mid cap plays look attractive, whereas in consumer IT, I probably think that it's the mid cap space, the small cap space, which looks very interesting.
What have you made of the kind of traction that we've seen within the auto space as a whole? Do you think that the road ahead for some of the two-wheelers will still look a little bit bumpy? And how are you advising investors to approach this entire basket?
Within the overall auto space, clearly the OEM space could be a bit of challenge in the very short term. We've seen already Tata Motors come up and in a way give a warning for JLR because of the chip shortage and some of the other supply chain related issues. So clearly believe that the OEM space is going to be a bit more challenged for a quarter or two. But I clearly believe that nevertheless, post this correction or a bit of more correction, they still will become attractive from a medium-term perspective. The space we like the most, which is a good proxy for the auto space, is the overhang space. We clearly believe that they have multiple growth drivers, be it demand from OEMs, be it demand from replacement market, be it demand from exports. Plus, of course, they run a relatively de-risked business model as they are spread out across OEMs, across markets, across product lines, and all of that. And some of these autohangs have basically a strategy to increase wallet share in the respective markets that they operate from. So clearly believe that that auto hangs is a relatively better proxy to auto OEMs to own, and clearly if there is any correction there, that would be a great time to load up on those names.
Nilesh, for those who are comparing Zomato's market cap with the market cap of the hospitality and hotel industry put together and the QSR businesses, will they get it wrong? Because you cannot compare an internet company with a brick and mortar hospitality company. But what I'm trying to understand is that when DMart went public, when Dr. Lal went public, when HDFC AMC went public, there's a lot of criticism that these are great businesses but available at very rich pricing. But for those who were able to see beyond the IPO pop in 2 or 3 years, they've made serious money in a DMart, Dr. Lal, or even HDFC AMC. Is Zomato in that category?
Well, yes. I mean, Zomato clearly is a very, very differentiated kind of a business model. It would be entirely wrong to kind of compare it with a whole bunch of either QSRs or a bunch of restaurants or a bunch of other hospitality plays. And the two things which you have to basically keep in mind is that these are digital first direct to consumer businesses. I think is the starting point. And when you kind of accept that as the starting point, your outlook, your perspective on some of these kind of internet driven businesses changes quite dramatically. Number two is that these are platforms. Today, they basically probably just do the listings business or they do basically the food delivery. But who knows, 3 years, 5 years, 10 years later, they could pretty much have a very, very expanded business model and a very expanded range of offerings. So that's the next thing. And third, of course, is basically the possibility of infinite scalability. A conventional QSR or a conventional hospitality play does not have, it's not physically possible for them to basically be able to scale up quite meaningfully. I think when you have a player like Zomato, which is more a platform and is driven by a digital first strategy, clearly it gets into the realm of infinite scalability. And that I believe is something which investors
All right. In moments from now, we'll also be joined by Rananjay Datta of Indigo to talk about what is the way forward for India's biggest airline company. I mean, Indigo now has 50% market share. If this pandemic has made one company strong, I mean, that's Indigo for you. They've gained market share from SpiceJet. They've gained market share from Air India. So it's a company where, in a sense, you've got one company enjoys 50% market share and they have a balance sheet strength. Other companies do not have the balance sheet strength. So unlike what a lot of people tell me that, look, there is going to be a disruptive war or a price war in the aviation market, I doubt. This is not the Indian telecom sector where you had that Reliance was able to, in a sense, come up with very low pricing because they had a balance sheet which was able to support Jio. In this case, Indigo, being the dominant player, they would not like to destroy the market, the pricing. So that's one conversation I'm really looking forward to. 32 rupees higher for Indigo. They're looking at raising capital. That shouldn't be a problem in today's environment. Okay, Nilesh, we lost you there in terms of your thoughts on Zomato.
Yeah, so you can, what I was basically saying is that I think it would be completely wrong to kind of start comparing with traditional QSRs or traditional hospitality plays. These are digital first businesses, they are direct to consumer businesses, and therefore the potential for them to be, in a way, pretty much theoretically scale their businesses infinitely, as I would probably look at it. I think that possibility should never be ruled out. And that's what optionality is all about. These internet-driven businesses are more about optionality rather than anything else. And so to that extent, I think the bigger challenge is going to be in terms of how do you basically put a price as to what levels would you want to kind of invest into them, and which I probably think currently is more a art than a science right now. So one will have to take a multi-year horizon, one will have to evaluate multiple possibilities, and then only basically be able to kind of really take a call on businesses like Zomato.
So where is the near-term surprise according to you which could come? Let's say in the next 3-4 quarters or next or FY23, where do you think markets are likely to get the growth estimates wrong? Where do you think markets are conservative and you think the pickup in demand or the pickup in real economy is going to be strong? Because one thing I want to bring out for viewers is that when demand comes back, it surprises everybody on the upside. And when the demand drops, it disappoints everybody on the downside.
So I clearly believe that while on one hand we are focused, we are kind of in a way pretty much right currently looking at or obsessed with some of these internet plays and digital plays and all of that. And then of course the pharma names, the IT services names, consumer names. These are all great businesses, great franchises. They're going to have strong growth and of course are relatively capital efficient business models. But one pocket which I still think that where growth could really surprise us is basically on this whole overall construction infrastructure build up as a space, and I clearly believe that of course, home developers, real estate players, I believe could be look currently undervalued. I mean, Nikunj, I can't imagine where equity markets are doing so well, interest rates are so low, and the demand for homes remains relatively tepid. Of course, we had strong demand in quarters like December and March, but that's been still kind of ephemeral. Clearly believe that going forward, you are going to see many more consumers wanting to basically, and aspirants wanting to go out and buy homes. So the demand for homes could basically be relatively stronger going forward, or if at all, at least there could be, pricing strength, which would come back to these home developers. So I think that's one pocket where currently the market still remains in a denial mode. But I would probably think that from at least a medium-term perspective, that as a space still, I believe, is not yet joined the consensus bandwagon of having high expectations. So that's one contrarian space which I think would look out. And on the back of that, I see very, very strong demand coming in for a lot of these building material companies. That plus along with that, the overall infrastructure construction and construction of many factories, warehouses, fulfillment sectors is going to drive demand for, products like wires, for cables, for other electrical fittings and cement and all of that, adhesives and that entire pack. I still believe that that's still a very, very interesting space.
Nilesh, if I may deviate a tad, and we wanted to get in your strategy or your mantra for getting rich, what's the advice that you have for investors as per you?
Well, all I can basically say is that the key mantra is that look at investing as a marathon. This is surely not a sprint. So to that extent, you have to be at it. There is really no substitute for basically doing your homework well and carrying conviction. That to me is basically the second kind of thing to it. So first of all is think long term, act long term, look at this as a marathon. The second, of course, is that do your homework well. That's the only thing which will give you conviction, especially in times of volatility. And take volatility in your stride.
Slow and steady, I guess. Nilesh, cement as a sector, it seems that even despite the fact that there was a second wave, there was those lockdowns, you had the overall, the pricing environment was rather challenging. How have you looked at the kind of performance that cement has delivered? And do you believe this consistency is here to stay?
It looks like at least that, it's always hard to take a very long-term view on cement, but I clearly believe that the short to medium term looks very interesting in case of cement. It looks like that a lot of the cement, capacities are operating at elevated levels or at levels which are relatively higher versus where they have been in the past. Of course, there are going to be pockets where more capacity is coming in, but it looks like that in context of demand and the capacity utilization, some bit of pricing power has come in for cement companies. And so that continues to present a nice short to medium term opportunity. Having said that, I still again believe that in cement you'll have to think regional, you will have to think local. It's hard to really take a pan-India view unless you are just basically an asset allocator, and therefore the top one or two cement companies become the natural choices. But I think if you step down and look at some of the other companies, you will have to take a very local or a regional perspective and see how that specific company is placed in that very local or the regional market. So we still continue to see opportunities out there, and that continues to be a very interesting space. In addition to that, of course, you can never rule out the possibilities of M&A. There are companies which are still wanting out there to basically go out and buy, provided there are capacity available. So the mid-cap cement space essentially still has a combination of both a bit of pricing power, strength in the relative market, and third, of course, is the potential for any kind of M&A.
Nilesh, been a pleasure chatting with you. Thank you so much for sharing your insights and market outlook.
Thank you.